Welcome. Trading is often described as a game of numbers, charts, and strategies, but beneath all the technical tools lies something far more powerful and far more dangerous: our emotions. Every trader, whether new or experienced, eventually realizes that fear, greed, excitement, and frustration have as much influence on the outcome as the market itself. A perfect strategy can collapse under the weight of panic, and a lucky streak can vanish when greed clouds judgment. This book is not about giving you another strategy or secret formula to beat the markets. Instead, it's about giving you mastery over yourself. Because in trading, your greatest enemy isn't the market. It's the way you react to it. In the chapters ahead, you'll learn how emotions shape your decisions in ways you may not notice. Why most traders fail, not because of knowledge, but because of psychology. Practical methods to manage fear, resist greed, and build discipline. And finally, how to trade with clarity, calmness, and confidence. Think of this as a journey inward. By the end, you'll see that controlling your emotions is not about suppressing them, but about understanding them, respecting them, and keeping them from taking control of your actions. So, before we dive into the strategies and lessons, take a moment. Breathe. Remind yourself why you're here. Because if you can master your emotions, you can master your trading. Chapter 1, Why Emotions Destroy Most Good Traders. When most people begin trading, they imagine that success comes down to knowledge. They believe that if they can just learn enough strategies, master enough technical indicators, or discover the perfect system, they will finally have the key to consistent profits. But very quickly, reality teaches a painful truth. Strategy alone is not enough. You can have the best system in the world on paper, but if you cannot control yourself, you will fail. It is not the market that destroys most traders. It is their emotions. Think about this. How many times have you seen a trader close a trade too early, not because their plan told them to, but because they were afraid of losing the little profit they had? How many times have you seen someone hold on to a losing position, not because their analysis justified it, but because they were too proud to admit they were wrong? These aren't failures of knowledge. They are failures of emotion, fear, greed, impatience, and overconfidence. These are the silent killers of trading accounts. They creep in when you least expect it, whispering lies into your ear, convincing you to act against your own plan. Let's start with fear. Fear is perhaps the most common and most destructive emotion in trading. When you see the market moving against you, fear takes over. It tells you to close the trade immediately, even if your analysis still supports holding it. Or worse, fear convinces you not to take trades at all, leaving you paralyzed while opportunities pass you by. Fear makes every decision feel dangerous. Every trade feel like it could end in disaster. And so, instead of trading with clarity, you trade with hesitation and doubt. Then there is greed. Greed often appears right after success. You win one or two trades, and suddenly your mind starts racing. You imagine how much money you could make if you just doubled your position size. You stop following your risk rules because you feel invincible. You start chasing trades that you never would have considered before. And at that exact moment, the market usually delivers a harsh lesson. One wrong move wipes out the gains you worked so hard for. Impatience is another silent enemy. In trading, waiting is often the hardest part. The best setups take time to form, but impatience pushes you to act too soon. You see half a signal and convince yourself it's enough. You jump into trades without confirmation because you feel the urge to always be in the market. The result? You end up with poor entries, unnecessary losses, and frustration that only grows stronger. And then there's overconfidence. Overconfidence is especially dangerous because it doesn't feel like an enemy. It feels like a friend. After a string of winning trades, you start to believe you cannot lose. You forget the risks, you ignore your stop losses, and you begin to trade recklessly. But markets are humbling. They don't care about your confidence. They only care about probabilities. And sooner or later, overconfidence leads to a painful reality check. Each of these emotions might seem small on their own. A little fear, a little greed, a little impatience. But in the high-stress environment of trading, they grow into powerful forces that can completely override logic and reason. This is why so many traders who look skilled on paper, who can analyze charts perfectly, who can explain risk management rules by heart, still fail when they step into the live market. Knowledge without emotional control is useless. To protect yourself, you must first accept a simple truth. Trading is not just a test of knowledge, it is a test of psychology. Until you master your emotions, you will repeat the same mistakes over and over again. Think about how many times this has happened to you. You make a plan before entering a trade. You decide your entry, your stop loss, your take profit. You feel confident. But the moment the trade is live, emotions creep in. Suddenly, the stop loss feels too tight. You move it further away. The market goes in your favor, but instead of taking profit at your planned level, you hold on, hoping for more. Or worse, the market starts to turn and you refuse to close the position, praying it will reverse. Each of these moments is not about knowledge, it is about emotion. This is why discipline is so important. A trading plan only works if you have the strength to follow it. Risk management only protects you if you actually respect it. And consistency only comes when emotions stop dictating your every move. The truth is, markets will always be unpredictable. You cannot control what the market does, but you can control how you respond. And that control, or lack of it, is what separates successful traders from those who fail. So here is the lesson of this chapter. If you lose trades because of fear, greed, impatience, or overconfidence, you are not weak, you are human. These emotions are natural. Every trader feels them. But trading success requires that you rise above them. Only when you recognize that your emotions are your greatest enemy can you begin the work of controlling them. And once you begin that work, everything changes. Trades become less stressful. Losses become lessons rather than disasters. Wins become rewards rather than temptations. And the market stops feeling like a battlefield and starts feeling like a place of opportunity. This is the foundation. If you can master your emotions, you can master your trading. In the next chapter, we will look deeper into why these emotions arise. We will explore the psychology of trading and how your own brain may be setting traps that lead you away from rational, profitable decisions. Chapter 2, the psychology of trading. How the brain betrays you. When you sit in front of the trading screen, you may think you are making decisions based on logic, data, and analysis. You believe you are being rational, but the reality is very different. Behind every click of the mouse, behind every trade you place, your brain is pulling invisible strings. And more often than not, those strings are working against you. Human beings did not evolve to trade financial markets. Our brains were designed thousands of years ago in a world of immediate survival, hunting, gathering, protecting our families. Back then, the ability to respond instantly to danger kept us alive. Today, those same survival instincts show up in the market, but instead of protecting us, they sabotage us. One of the most powerful examples is loss aversion. Psychologists have shown that human beings feel the pain of loss about twice as strongly as they feel the pleasure of an equivalent gain. In simple terms, losing $100 hurts far more than winning $100 feels good. In trading, this bias is deadly. It pushes traders to avoid losses at all costs, even if that means holding on to losing positions far longer than they should. Instead of accepting a small, controlled loss, the brain convinces you to wait, to hope, to pray that the market will turn back in your favor. More often than not, that small loss grows into a devastating one. Another mental trap is confirmation bias. Once you form an opinion about the market, for example, that a stock is going to rise, your brain starts filtering information to confirm that belief. You focus on the bullish news, the positive indicators, the signs that support your view, while ignoring the warnings that tell you otherwise. In trading, this selective attention can blind you to reality. By the time you finally see the full picture, it is often too late. There's also the fight or flight response. When the market moves suddenly against you, your brain reacts as if you were facing a physical threat. Your heart races, your breathing quickens, stress hormones flood your body. In that state, rational thought shuts down. You are not calmly evaluating probabilities. You are reacting instinctively, trying to escape danger. And in trading, those split-second emotional reactions usually lead to bad decisions, closing trades too soon, moving stop losses, or jumping into revenge trades. Overconfidence is another psychological trap. After a string of wins, the brain tricks you into believing that success was entirely due to your skill rather than a mix of analysis and probability. You begin to believe you cannot lose. This illusion of control tempts you to ignore risk management, increase your trade size, or take trades outside your strategy. And inevitably, the market reminds you, sometimes harshly, that overconfidence is just another form of blindness. Impatience, too, has roots in our psychology. The human brain craves activity. We are wired to feel rewarded when we take action, not when we wait. In everyday life, this instinct often serves us well. But in trading, waiting is often the most profitable action. The best opportunities come to those who are patient. Yet the brain hates inactivity. It pushes you to enter trades too soon, to chase signals that aren't fully formed, to do something, anything, just to feel in control. The result is often a string of unnecessary losses. And then there is herd mentality. From the earliest days of human history, survival depended on sticking with the group. Those who followed the crowd had safety in numbers. Today, that instinct shows up in the markets as herd behavior. chasing trends because everyone else is buying, selling in panic because everyone else is selling. Following the herd may feel safe, but in trading, it often means buying at the top and selling at the bottom. These psychological traps are not signs of weakness. They are signs of humanity. Every trader experiences them. The difference between those who fail and those who succeed is not whether they feel these instincts, but whether they understand them and learn to manage them. So how do you begin to manage the brain's betrayal? The first step is awareness. When you know that loss aversion exists, you can pause and ask yourself, am I holding this trade because it's still valid or just because I don't want to feel the pain of a loss? When you know about confirmation bias, you can force yourself to look for evidence against your trade, not just in favor of it. The second step is structure. Because your brain is wired to react emotionally, you must build systems that remove decision-making from moments of stress. This means writing down your trading plan before you enter a trade. Your entry, your stop loss, your target. Once the trade is live, your job is simply to follow the plan. No negotiation, no debate, just execution. The third step is acceptance. You must accept that losses are part of trading. Every professional trader loses. The difference is that they keep those losses small, controlled, and unemotional. When you accept that losing is not a failure, but simply part of the process, you free yourself from the grip of loss aversion. Finally, you must cultivate emotional resilience. This does not mean suppressing your emotions. It means noticing them without letting them control you. Techniques like journaling your trades, practicing mindfulness, or reviewing your emotional state each day can help you build this resilience over time. Trading is not a battle against the market. It is a battle against yourself, against instincts and biases that were programmed into you long before financial markets even existed. The market is not out to get you. Your own brain is the one laying the traps. But once you understand how your psychology works, you can stop being a victim of those traps. You can see fear, greed, impatience, and overconfidence for what they are. Natural impulses that must be acknowledged but not obeyed. Remember this, success in trading is not about eliminating emotions, because that is impossible. It is about understanding them so deeply that they lose their power over you. As we move forward, we will begin to explore practical tools and methods to apply this knowledge in real trading situations. But before that, you must truly grasp this lesson. The brain you bring to the market is not built for trading. It will betray you if you let it. Your job is to rise above those instincts, to think beyond the fight or flight response, to trade with discipline rather than impulse. Once you do, you will begin to experience something rare in trading, clarity. The noise of the market will not shake you as easily. The ups and downs will no longer feel like a roller coaster. You will begin to act less like a gambler and more like a professional. This is the path, and it begins with the simple but difficult task of recognizing that the greatest enemy in trading is not the market. It is your own mind. In the next chapter, we will explore how to build discipline, the daily habits and structures that allow you to rise above emotions and biases and to trade with consistency. Chapter 3, Greed. The silent killer of profit greed is one of the most dangerous emotions in trading, not because it always feels reckless, but because it often disguises itself as ambition. On the surface, greed looks like hunger for success, drive, or motivation. But when left unchecked, greed silently takes control of your decisions, leading you down a path that almost always ends in loss. Every trader has felt it. You take a winning trade, close it in profit, and within seconds, your mind is racing. What if I had taken a larger position? What if I had held on a little longer? The victory that should have boosted your confidence instead fuels dissatisfaction. You feel that what you earned wasn't enough, that you could have squeezed more out of the market. This is greed at work. Greed shows up in many forms. Sometimes it's the urge to increase your lot size after a string of winning trades. Sometimes it's the temptation to ignore your take-profit target because you're convinced the market will keep moving in your favor. Other times, it's the pressure to chase after every opportunity, desperate not to miss the next big move. In each case, greed pushes you to abandon discipline, to take risks that your plan never accounted for. The tragedy of greed is that it always ends the same way. The market reverses, your oversized position collapses, and the gains you worked so hard to build are wiped away in a single move. What began as confidence turns into frustration. What felt like ambition turns into regret. Why does greed affect traders so deeply? The answer lies in the way our brains process reward. Human beings are wired to crave more. Each time we experience a win, our brain releases dopamine, a chemical that creates pleasure and excitement. The more we win, the more we crave that feeling. But the brain doesn't stop at satisfaction. Instead, it raises the bar, convincing you that the next win must be bigger, faster, more impressive. In trading, this constant craving becomes a trap. It makes consistent profit feel boring, and it pushes you to gamble instead of trade. Consider the story of a trader who starts small. At first, they are disciplined, carefully following their plan. Their account grows slowly but steadily. But after a series of wins, greed begins whispering. Why settle for small gains when you could double your profit by doubling your position? The trader listens. At first it works. The larger size delivers larger wins. But sooner or later, the market turns. And because the trader has abandoned risk management, the loss is devastating. Months of careful progress vanish in a single trade. This cycle repeats itself across thousands of traders every day. And the sad truth is that most never escape it. They are caught in a loop of greed and loss, forever chasing more but never finding satisfaction. So how do you defeat greed? The first step is awareness. You must learn to recognize its voice. Greed often disguises itself in reasonable-sounding thoughts. I should maximize my gains. This trade looks too good to miss. If I just risk a little more, I'll recover faster. Each of these statements seems logical, but underneath them is the same dangerous impulse, the desire for more than what your plan allows. The second step is structure. Just as with fear, you cannot rely on willpower alone to control greed. You need systems that protect you from yourself. This means setting fixed rules for position sizing and never breaking them. It means respecting your take-profit levels, even when you're convinced the market will go further. It means treating every trade as just one in a long series, not as the single trade that must make you rich. The third step is gratitude. Greed thrives on dissatisfaction, the belief that what you have is never enough. To counter it, you must learn to value consistency over excitement. A small profit that you take according to plan is a victory, even if the market moves further afterward. A disciplined exit is success, even if you feel you could have earned more. By training yourself to feel gratitude for disciplined gains, you weaken the hold of greed. Another powerful technique is to reframe your goals. Instead of focusing on how much money you can make in a single trade, focus on following your process correctly. Let your measure of success be discipline, not dollars. Ask yourself after each trade, did I follow my plan? Did I stick to my rules? If the answer is yes, then you have succeeded, regardless of the size of the profit. It is also helpful to remind yourself of the bigger picture. Trading is not a sprint, it is a marathon. The goal is not to make as much as possible today, but to be profitable over the long term. Greed thrives on short-term thinking, the illusion that one trade can change your life. But professional traders know that no single trade matters as much as the overall process. Your edge comes from consistency, not from chasing jackpots. Some traders find it useful to build rituals to check greed. For example, before entering a trade, write down your planned entry, stop loss, and take profit. Commit to them. During the trade, if greed tempts you to break the plan, pause and read what you wrote. Remind yourself that your job is not to predict every move, but to execute your plan faithfully. Finally, accept that you will never completely eliminate greed. It is part of human nature, but you can learn to manage it, to see it clearly, and to choose discipline instead. Every time you resist greed, you strengthen your resilience. Every time you follow your plan instead of your impulse, you prove to yourself that you are in control. Greed is called the silent killer of profit because it doesn't always feel dangerous. It feels exciting. It feels motivating. But beneath the surface, it is the voice that pushes you off balance, that convinces you to risk everything for just a little more. If you let it control you, it will destroy you. If you learn to master it, you will join the small group of traders who not only survive, but thrive. Remember this, in trading, it is better to earn steady, modest gains with discipline than to chase extraordinary wins with recklessness. Greed whispers promises of riches, but it delivers only regret. Discipline may feel slow, but it is the path to true wealth. In the next chapter, we will turn our attention to another powerful emotion, fear. If greed drives you to risk too much, fear does the opposite. It holds you back, convincing you to miss opportunities and abandon trades too soon. Together, greed and fear are the twin forces that destroy traders. Understanding both is essential if you want to break free from their control. Chapter 4. Fear, the invisible barrier to growth. If greed is the force that drives traders to risk too much, fear is the force that holds them back. Fear is subtle, quiet, and often invisible, but it has the power to paralyze even the most skilled trader. It is the emotion that keeps you from pulling the trigger on a perfectly valid setup. It is the reason you close trades too early, cutting winners short before they have a chance to grow. And it is the emotion that makes every loss feel heavier than it really is. Fear takes many forms in trading. There is the fear of losing money, the fear of missing out, the fear of being wrong, and the fear of repeating past mistakes. Each of these fears whispers in the back of your mind, influencing your decisions without you even realizing it. Left unchecked, fear becomes an invisible barrier that limits your growth, holding you back from reaching your full potential as a trader. Let's start with the most common, the fear of losing money. This is natural. Nobody likes to lose. But in trading, losses are inevitable. They are not just possible, they are guaranteed. Even the best traders lose. The difference is that professionals accept small losses as part of the process, while fearful traders see every loss as a personal failure. Fear makes you hesitate. It keeps you from taking trades that fit your plan because you are too focused on what might go wrong. In the end, you miss opportunities not because the market wasn't there, but because fear wouldn't let you act. Then there is the fear of missing out, often called FOMO. This fear doesn't hold you back. Instead, it pushes you forward recklessly. You see the market moving without you, and fear convinces you that if you don't jump in right now, you will miss your chance forever. So you enter late, at the worst possible price, and the market immediately reverses. FOMO is a fear that pretends to be opportunity, but in reality, it is just another trap. The fear of being wrong is more subtle, but just as destructive. For many traders, being wrong feels worse than losing money. It feels like an attack on their ego, a threat to their identity. This fear leads traders to avoid taking trades unless they feel 100% certain, which of course is impossible. It also makes them hold on to losing trades far too long, because closing the trade would mean admitting they were wrong. In this way, fear of being wrong magnifies losses and prevents growth. And then there's the fear of the past. Every trader has scars. A big loss, a blown account, a painful mistake. These memories live in the mind, waiting to resurface when a similar situation appears. Fear convinces you that history will repeat itself, that you cannot trust yourself, that it's safer not to try. This fear chains you to the past, keeping you from moving forward with confidence. Fear is powerful because it feels protective. It whispers that it is keeping you safe, shielding you from danger. But in trading, fear doesn't protect you. It sabotages you. It blinds you to opportunities, pushes you into bad entries, and keeps you from executing your plan. In trying to avoid pain, fear creates even more of it. So how do you overcome fear? The first step is acceptance. You cannot eliminate fear. You cannot force yourself to stop feeling it. Fear is part of being human, but you can accept that fear will always be there and learn to act in spite of it. The second step is preparation. Fear thrives in uncertainty. The less prepared you are, the stronger fear becomes. But when you have a clear plan, your entry, your stop loss, your target, fear has less room to control you. You don't need to make decisions in the heat of the moment because you already decided in advance. Preparation is the antidote to hesitation. The third step is reframing loss. Instead of seeing a loss as failure, see it as feedback. Every loss is data. Every stop out is information that makes your system stronger. When you truly understand that losses are not personal but simply part of the trading business, fear of losing money begins to fade. The fourth step is gradual exposure. If fear of risk overwhelms you, start small. Trade with size so small that losses barely matter. Build confidence not by eliminating fear, but by proving to yourself over time that you can handle it. As your confidence grows, so does your ability to take on larger risks without being paralyzed. Finally, you must build trust. Trust in yourself and in your system. Fear thrives when you doubt your own ability. But when you journal your trades, track your progress, and see proof of your consistency, trust begins to replace fear. Confidence doesn't come from hoping. It comes from evidence. Remember this. Fear will always whisper. It will always tell you not to act, or to act too soon, or to avoid risk at all costs. But you are not your fear. You can notice it without obeying it. You can feel it without being controlled by it. The invisible barrier to growth is not the market, not your strategy, not even your knowledge. It is fear. Once you learn to face it, accept it, and act with discipline despite it, that barrier begins to crumble. The greatest traders are not fearless. They feel fear just like everyone else. The difference is that they refuse to let fear decide for them. In the next chapter, we will turn to discipline, the real trading strategy. Because no matter how much you learn about emotions, psychology, or the markets themselves, without discipline, nothing else matters. Chapter 5. Discipline, the real trading strategy. Everywhere you look, traders are searching for the perfect system. They spend hours testing indicators, analyzing strategies, and chasing after the next big method that promises guaranteed profits. But ask any professional trader what truly separates winners from losers, and you'll hear the same answer over and over again. Discipline. Discipline is the real trading strategy. Without it, no system will ever work. With it, even a simple system can become powerful. Trading is not about knowing everything, it is about executing consistently. And execution is impossible without discipline. So what is discipline in trading? Discipline is the ability to follow your plan no matter what. It is sticking to your entry and exit rules, even when your emotions scream at you to do the opposite. It is risking only what you said you would risk, no more and no less. It is treating every trade as just one step in a long journey, instead of gambling on it as if it were your last chance. Think about it this way. You could give the exact same trading system to 100 people. On paper, they all have the same edge. But in reality, only a handful will make money. Why? Because only a handful will have the discipline to actually follow the rules. The rest will let fear, greed, and impatience pull them off course. The edge is not in the system. The edge is in the discipline to follow it. Discipline begins with a plan. A clear, written trading plan is the foundation. It defines when you enter, when you exit, how much you risk, and how you manage trades. Without a plan, you are not trading. You are gambling. But a plan alone is not enough. The challenge is sticking to it. And this is where most traders fail. Why is discipline so difficult? Because emotions are powerful. Fear convinces you to close trades too early. Greed convinces you to hold too long. Impatience pushes you to enter without confirmation. Overconfidence tempts you to ignore your risk limits. Every emotion you feel in the market is designed to pull you away from discipline. The only way to win this battle is to build habits and systems that make discipline easier to maintain. For example, one simple habit is to set your stop loss and take profit levels the moment you enter a trade, and then step away. By automating your exits, you remove the temptation to interfere. Another habit is to use consistent position sizing, so you never risk more just because you feel confident. These small habits protect you from emotional decisions in the heat of the moment. Another key part of discipline is patience. Good setups don't appear every minute. Sometimes the best trade you can make is no trade at all, but patience is hard, because the brain craves action. Discipline means waiting for your edge to appear, even if that means sitting on your hands for hours, days, or even weeks. Discipline also means respecting risk. Many traders understand risk management in theory, but abandon it in practice. They move stop losses further away, add to losing trades, or double their position size out of frustration. Each time they break the rules, they tell themselves it's just this once. But the truth is, every time you break your risk rules, you weaken your discipline. And without discipline, risk will eventually destroy you. So how do you build discipline? The first step is commitment. You must decide, truly decide, that following your plan matters more than winning any single trade. Discipline requires that you value process over outcome. Even if a trade loses, if you followed your plan, you succeeded. Even if a trade wins, if you broke your rules, you failed. This mindset shift is essential. The second step is accountability. Write down your trades, journal your decisions. At the end of each day, review whether you followed your plan. If you didn't, ask yourself why. What emotion took control? What situation tempted you to break your rules? By holding yourself accountable, you bring awareness to the moments where discipline slipped. And awareness is the first step toward improvement. The third step is routine. Discipline thrives on structure. If you trade at random times, with random preparation, your discipline will always be fragile. Build a routine around your trading. Have a set time for analysis. Review your plan before the session begins. Take breaks to clear your mind. The more structured your routine, the easier it is to remain disciplined under stress. The fourth step is self-control outside of trading. Discipline is not just something you practice at the charts. It is a way of life. If you struggle with self-control in your daily habits, in your sleep, your health, your spending, that lack of discipline will follow you into trading. By strengthening discipline in all areas of your life, you strengthen it in your trading. And finally, remember that discipline is not perfection. You will slip, you will break your rules, you will have days where emotions get the better of you. That is normal. The key is not to demand perfection, but to aim for progress. Each time you catch yourself breaking discipline, you have a chance to learn. Each time you return to your plan, you grow stronger. Discipline is built over time through repetition and reflection. At its core, discipline is freedom. When you are disciplined, you no longer have to wrestle with constant emotional decisions. You no longer wonder what to do in the heat of the moment. You know your rules and you follow them. Discipline frees you from the chaos of impulse and gives you the clarity to execute consistently. So ask yourself, are you chasing the perfect strategy? Or are you building the discipline to follow any strategy with consistency? Because in the end, the greatest edge in trading is not knowledge, not indicators, not even experience. The greatest edge is discipline. In the next chapter, we will build on this foundation and explore how to master the moment, how to stay calm during a trade, even when the market is moving against you. Because discipline begins before the trade, but it must continue in the heat of battle. Chapter 6, Mastering the Moment, How to Stay Calm. During a trade placing, a trade is only the beginning. What comes after? The waiting, the uncertainty, the swings of the market is often the hardest part. Many traders can prepare a plan, analyze the charts, and identify solid entries. But once the trade is live, emotions begin to surge. Fear and greed fight for control. Doubt creeps in. Every tick feels like a test of patience, and if you cannot stay calm in that moment, all the planning in the world won't save you. Mastering the moment means learning to remain steady while the trade unfolds. It means keeping your mind clear, your heart calm, and your actions disciplined. Even as the market tries to pull you in every direction. This is one of the most difficult skills to learn, but it is also one of the most powerful. Because in the heat of the trade, emotions are at their strongest, and the ability to remain calm is what separates professionals from amateurs. Why is it so difficult to stay calm during a trade? The answer lies in how the brain perceives. Uncertainty. The human mind craves control. We want to know what will happen, to predict the future, to feel safe. But trading is uncertainty by definition. No matter how good your analysis, no outcome is ever guaranteed. That uncertainty triggers the brain's stress response. Your body reacts as if you are in danger, heart racing, adrenaline pumping, thoughts speeding up. You are no longer calmly evaluating probabilities. You are in survival mode. This survival response shows up in different ways. Some traders panic when the trade goes slightly against them, closing early to escape the discomfort. Others do the opposite. They freeze, unable to take action, hoping the market will somehow move in their favor. Still others overreact, adding more to their position or adjusting their stops impulsively. All of these are emotional responses, not rational decisions. The first step to mastering the moment is preparation. Calmness during a trade begins long before the trade is placed. If you enter without a clear plan, uncertainty will overwhelm you. But if you know your entry, your stop loss, your target, and your risk, then the outcome no longer rests on your emotions. You've already made the decisions. Your job now is simply to execute. The second step is acceptance. Once the trade is live, you must accept that the outcome is out of your control. The market will do what it will do. Your job is not to control the market. Your job is to control yourself. By accepting uncertainty as part of trading, you release yourself from the constant need to monitor every tick. The third step is focus. Many traders make the mistake of staring at their screens, watching every tiny movement of price. This magnifies emotions. A small pullback feels like disaster. A small rally feels like triumph. The constant up and down becomes exhausting, and emotions eventually take over. To stay calm, you must zoom out. Focus on the bigger picture. Trust your analysis. Remind yourself that individual candles do not matter. The overall trade setup does. Sometimes the best way to stay calm is to simply step away from the screen. The fourth step is breathing. It may sound simple, but deep, steady breathing has a powerful effect on the nervous system. When stress begins to rise, take slow breaths. Inhale deeply, hold for a moment, exhale slowly. This signals to your body that you are safe, calming your heart rate and clearing your mind. The calmer your body, the clearer your thoughts. Another tool is visualization. Before entering a trade, visualize the different possible outcomes. Imagine the trade going in your favor and imagine it going against you. See yourself calmly following your plan in both situations. By rehearsing in your mind, you prepare yourself emotionally for whatever happens. When the moment arrives, it no longer feels unfamiliar. You've already practiced it. Journaling can also help. After each trade, write down what you felt. Were you anxious, excited, tempted to interfere? By recording your emotions, you begin to see patterns. You notice what triggers your reactions. And once you know your triggers, you can prepare for them. Awareness is the first step to mastery. Another powerful technique is to set rules that limit interference. For example, once you place a trade, promise yourself you will not touch it for a certain period of time, or decide that you can only move your stop in the direction of profit, never against it. These rules act as guardrails, keeping you safe from emotional impulses. It is also important to remember perspective. One trade does not define you. One trade will not make or break your career. When you put too much weight on a single trade, emotions skyrocket. But when you remind yourself that trading is a long-term game, it becomes easier to relax. Each trade is just one of hundreds, one of thousands. Your job is not to win them all, but to remain consistent over time, mastering. The moment also requires trust. Trust in your system, trust in your process, and trust in yourself. Doubt creates anxiety, confidence creates calmness. But true confidence does not come from blind hope. It comes from evidence. The more you practice your system, journal your trades, and review your results, the more proof you gather that you can trust yourself. That proof becomes the foundation of calmness. Finally, learn to detach. The money in the trade is not your rent, not your food, not your survival. It is risk capital. Money you already accepted you could lose. When you detach from the outcome, when you no longer tie your identity or self-worth to every trade, calmness becomes natural. The trade is no longer a test of who you are. It is simply one more step in the process. Mastering the moment is not about never feeling stress. It is about noticing stress and refusing to let it control you. It is about creating space between the emotion and the action. The market may move wildly, your heart may pound, your mind may race, but discipline holds steady. You breathe, you remember your plan, you trust your process. That is calmness. That is mastery. When you can stay calm during a trade, you stop sabotaging yourself. You stop cutting winners short, stop moving stops impulsively, stop chasing after every tick. Instead, you trade with clarity. You allow your edge to play out. And over time, this calm discipline compounds into consistency and profitability. The market will always test you. It will always tempt you to abandon your plan. But in those moments, remember, your greatest advantage is not predicting what comes next. Your greatest advantage is the ability to remain calm while everyone else panics. In the next chapter, we will confront one of the most dangerous expressions of lost control: revenge trading and emotional overtrading. Because staying calm during a single trade is only part of the battle. The real challenge is maintaining composure after a loss, when emotions are at their most powerful. Chapter 7. Revenge. Trading and emotional overtrading. Every trader knows the sting of a loss. You followed your plan, you placed the trade, and the market moved against you. Sometimes the loss is small, sometimes it's devastating. Either way, the emotion is the same: frustration. But what you do after that frustration makes all the difference. For many traders, one loss doesn't stay as one. Instead, it triggers a chain reaction of emotional decisions. You feel the urge to make back what you lost. Immediately, you jump back into the market without proper analysis. You take trades that don't meet your rules. You increase your risk, hoping to recover faster. This is revenge trading, and it is one of the fastest ways to destroy an account. Revenge trading is driven by pride as much as by frustration. When you take a loss, it feels personal. It feels like the market has embarrassed you, like you've been proven wrong. Your ego demands to strike back, to prove that you are still in control. But the truth is, in those moments, you are no longer in control at all. The market isn't your opponent, your emotions are. And when you try to fight the market out of anger, you almost always lose. Emotional overtrading is closely related. Instead of revenge against a single loss, overtrading comes from a constant need to be in the market. It's the feeling that sitting on the sidelines is wasted time. You chase every move, open too many positions, or trade far more frequently than your system calls for. At first, this may feel exciting, but soon the mistakes pile up and your account pays the price. Both revenge trading and overtrading share the same root problem: loss of discipline. They are what happens when emotion seize control and push you into action for the sake of relief, not for the sake of strategy. And the danger is that in the moment, it doesn't feel reckless, it feels necessary. After loss, the urge to win back money feels logical, even justified. After missing a move, the urge to jump in late feels urgent. But in reality, both are traps. So how do you stop yourself from falling into them? The first step is awareness. You must recognize the signs of revenge trading before they happen. Ask yourself, why am I entering this trade? Is it truly part of my plan, or am I simply trying to erase the pain of a loss? If the answer is the latter, step away. Even a few minutes of reflection can save you from hours of regret. The second step is rules. Create specific rules that protect you from emotional spirals. For example, decide in advance that after 2 consecutive losses, you will stop trading for the day, or limit yourself to a maximum number of trades per session. These rules create boundaries that prevent one bad trade from turning into 10. The third step is perspective. Losses are not failures, they are costs of doing business. No business in the world operates without expenses, and trading is no different. When you see losses as business expenses rather than personal attacks, the urge for revenge weakens. You no longer feel the need to fight back. You simply record the expense and move on. The fourth step is recovery. After a painful loss, give yourself time to reset. Step away from the screen, take a walk, clear your mind. The market will always be there. You do not need to make it back immediately. In fact, the fastest way to recover is to trade less, not more. Trade only when your setup appears again. Trade only when your mind is clear. Another powerful technique is journaling. Each time you feel the urge to revenge trade, write it down. Record what happened, how you felt, and what you did. Over time, you will begin to notice patterns. You will see how often revenge trading made things worse. This awareness builds self-control. The next time the urge comes, you will remember the pain it caused before, and that memory will help you resist. It also helps to lower the pressure on each trade. Revenge trading often comes from putting too much emotional weight on a single trade. When you risk money you cannot afford to lose, every loss feels catastrophic. But when you risk only a small, comfortable amount, losses are easier to accept. Smaller risk reduces the emotional charge, making it easier to avoid chasing after the market. Revenge trading and overtrading also thrive on fatigue. The longer you stare at the screen, the more likely emotions will take control. Tiredness weakens discipline. Overexposure magnifies frustration. To fight this, build breaks into your routine. Step away regularly, reset your perspective, and return with a clear mind. Above all, remind yourself that trading is not about winning every battle. It is about surviving long enough to win the war. A single loss is nothing in the context of hundreds of trades. A losing day is nothing in the context of months and years. Revenge trading convinces you that you must win now. But successful trading is about consistency, not urgency. The truth is, revenge trading and overtrading will tempt you again and again. You cannot eliminate the urge entirely, but you can learn to recognize it, resist it, and replace it with discipline. Every time you walk away instead of forcing a trade, you grow stronger. Every time you accept a loss instead of trying to erase it immediately, you prove to yourself that you are in control. Remember, the market does not know you, and it does not care about you. It is not your enemy, and it is not your friend. It is neutral. The fight is not against the market. The fight is against your own emotions. And in that fight, the only way to win is through patience, discipline, and calm. In the next chapter, we will talk about how to recover after losses, how to reset emotionally, regain confidence, and return to the market with clarity. Because the real challenge is not avoiding every loss. The real challenge is how you handle them when they inevitably come. Chapter 8, Emotional Recovery. Resetting. After losses, every trader loses. It doesn't matter how skilled, how disciplined, or how experienced you are. Losses are part of the game. What separates professionals from amateurs is not whether they lose, but how they recover. Emotional recovery is one of the most overlooked skills in trading, yet it is one of the most important. Because it's not the first loss that destroys traders, it's what happens after. For many, a loss is not just financial. It feels personal. It feels like failure, like proof that they are not good enough, smart enough, or disciplined enough. That sting often lingers long after the trade is closed. If it's not handled properly, that pain can carry into the next trade, and the one after that, leading to a downward spiral. Revenge trading, overtrading, and reckless risk-taking are often symptoms of unresolved emotional pain. So how do you reset after a loss? How do you calm your emotions, regain focus, and step back into the market with clarity? The first step is acceptance. A loss does not mean you failed. It does not mean your system is broken. It does not mean you are not cut out for trading. Losses are the cost of doing business. They are as natural to trading as expenses are to any business. Once you accept that losses are inevitable, they lose much of their emotional weight. Instead of seeing them as failures, you see them as part of the process. The second step is perspective. One loss is nothing in the context of hundreds of trades. A losing day is nothing in the context of a year. But in the moment, it feels enormous. That's why you must zoom out. Look at your journal. Review your long-term progress. Remind yourself that trading success is measured over months and years, not minutes and hours. Perspective transforms pain into patience. The third step is to pause. Do not rush back into the market after a loss. Give yourself space to process. Take a walk, stretch, breathe. If the loss was particularly painful, take the rest of the day off. The market will always be there tomorrow. You gain nothing by rushing back in when your emotions are raw. In fact, the fastest way to recover is often to stop trading until your mind is clear. The fourth step is reflection. Ask yourself, what happened? Did you follow your plan and the trade simply didn't work out? If so, that's a good loss, a necessary loss. Or did you break your rules, chase after a setup, or risk too much? If so, that's a lesson. Either way, reflection turns every loss into growth. The worst thing you can do is ignore it. The best thing you can do is learn from it. The fifth step is journaling. Write down what you felt. Were you angry, disappointed, anxious? Did you feel the urge to take revenge trades? Journaling brings emotions out of your head and onto paper where they lose much of their power. It also helps you spot patterns. Over time, you'll notice how certain triggers affect you, and you'll be able to prepare for them in the future. The sixth step is to practice self-compassion. Trading is hard. Even the best traders make mistakes. Beating yourself up only makes recovery harder. Instead, treat yourself as you would a friend. If your friend took a loss, you wouldn't tell them they're a failure. You'd remind them that it's part of the journey, that they can learn and improve. Give yourself that same kindness. Another important part of recovery is resetting your state. Losses create tension in the body, stress, tightness, fatigue. To reset, you must release that tension. Physical movement, deep breathing, meditation, or even just stepping outside can all help. The body and mind are connected. When you calm the body, you calm the mind. Some traders also create rituals to mark the end of a loss. For example, after closing a losing trade, they might physically stand up, close their trading journal, and walk away for a few minutes. This simple act signals to the brain that the loss is over, that it does not carry into the next trade. Rituals like these help you compartmentalize, preventing one trade from bleeding into the next. It is also helpful to focus on process rather than outcome. Instead of asking, "Did I win?" ask, "Did I follow my plan?" If the answer is yes, then you succeeded, even if the trade lost. This shift removes much of the emotional sting from losses. You cannot control the market, but you can control yourself. Process over outcome is the mindset that creates resilience. Finally, rebuild confidence gradually. After a painful loss, you may feel shaken. The worst thing you can do is jump back in with high risk, desperate to prove yourself. Instead, lower your size. Trade small, trade simple, trade safe. Prove to yourself again that you can follow your plan. Each small, disciplined trade rebuilds trust in yourself. And once that trust is restored, confidence naturally returns. Remember this: losses are not the enemy. They are part of trading. The real enemy is carrying the emotional weight of losses forward, letting them control your next decisions. Emotional recovery is the skill that breaks this chain. It turns setbacks into lessons, pain into patience, and fear into resilience. Every trader falls down, but the best traders know how to get back up, quickly, calmly, and with clarity. That is emotional recovery. That is what allows you to keep moving forward, no matter how many times the market knocks you back. In the next chapter, we will take recovery a step further and explore the mindset rituals that keep you strong for the long run. Because emotional control is not just about handling one loss, it is about building daily practices that protect your mental energy and maintain your focus over years of trading. Chapter 9, Mindset. Rituals for long-term success trading is not just about strategies and charts. It is about mindset. And mindset is not built in a single moment. It is built every day through small habits that compound into strength. Without these rituals, even the most skilled trader eventually burns out. With them, you protect your focus, your energy, and your resilience for the long run. The truth is, trading is demanding. It requires patience, discipline, and clarity under pressure. It exposes you to constant stress, uncertainty, and emotional swings. Without deliberate rituals to recharge and refocus, it's easy to fall into fatigue, frustration, or emotional exhaustion. That is why mindset rituals are so important. They are not luxuries, they are necessities. The first ritual is preparation. Successful traders don't sit down and randomly open trades. They begin each day with a routine. This might include reviewing news, analyzing charts, updating a watch list, or meditating before the session. The purpose is not just analysis, it is mental readiness. A consistent pre-market ritual signals to your brain that it is time to trade with focus, not impulse. The second ritual is journaling. After every trade, write down what happened, not just the technicals, but the emotions you felt. Did you feel fear, greed, patience, frustration? Over time, journaling creates a mirror of your psychology. You see patterns, strengths, and weaknesses that you cannot see in the moment. Journaling is one of the most powerful rituals for long-term growth because it keeps you honest with yourself. The third ritual is reflection. At the end of each day or week, step back and review your performance. Not just wins and losses, but how well you followed your plan. Did you stay disciplined? Did you manage risk? Did you let emotions interfere? Reflection turns experience into wisdom. Without it, you may keep repeating the same mistakes. With it, every mistake becomes a lesson that strengthens you. The fourth ritual is visualization. Before you trade, close your eyes and imagine yourself in different scenarios. Imagine a trade going in your favor. Imagine a trade going against you. Visualize yourself staying calm, following your plan, and accepting the outcome with discipline. This mental rehearsal trains your brain to respond calmly in real situations. Professional athletes use visualization to prepare for competition. Traders can use it to prepare for the market. The fifth ritual is recovery. Just as athletes rest after training, traders must rest after trading. The brain cannot perform at peak levels indefinitely. If you spend every hour glued to the screen, fatigue will slowly erode your discipline. Build daily rituals that help you recharge. Exercise, meditation, reading, or simply spending time away from the charts. Recovery is not wasted time. It is an investment in your longevity as a trader. The sixth ritual is gratitude. Trading can easily become a cycle of dissatisfaction. No profit ever feels enough. No progress ever feels fast enough. Greed thrives on this dissatisfaction. Gratitude breaks the cycle. At the end of each day, write down something you are grateful for. It could be a disciplined trade, a small profit, or even just the fact that you stuck to your rules. Gratitude shifts your focus from what you lack to what you have, grounding you in discipline instead of impulse. The seventh ritual is routine outside of trading. Mindset is not built only at the charts, it is built in your lifestyle. Sleep, nutrition, exercise, and balance all affect your trading psychology. If you neglect your body, your mind suffers. If you live in constant chaos, your trading will reflect it. Build rituals in your daily life that support clarity, regular sleep, healthy food, physical movement. A strong body supports a strong mind, and a strong mind supports disciplined trading. The eighth ritual is detachment. Create boundaries between trading and the rest of your life. When the session ends, leave the market behind. Do not carry the stress of trades into your relationships, your conversations, or your rest. Detachment protects your mental health. Remember, you are not your trades. You are more than your account balance. Building this separation allows you to trade with freedom without tying your self-worth to every outcome. The ninth ritual is affirmation. The words you repeat to yourself shape your mindset. Many traders unconsciously reinforce negativity. I always lose. I can't control myself. I'm not good enough. These thoughts become self-fulfilling. Replace them with affirmations. I am disciplined. I trust my process. Losses are part of my growth. I'm calm and patient. Repeat them daily. Over time, your brain begins to believe them, and belief shapes behavior. The 10th ritual is consistency. Rituals only work if you repeat them. Doing them once or twice will not change you, but doing them daily, weekly, month after month creates transformation. Mindset is like muscle. It strengthens with consistent training. Your rituals are the training ground. Each time you practice them, you reinforce discipline. Each time you skip them, you weaken it. Together, these rituals build resilience. They protect you from burnout, help you manage stress, and keep your psychology sharp over the long run. They ensure that trading does not just become a grind, but a sustainable practice you can maintain for years. Mindset rituals may seem small, even simple, but do not underestimate their power. The difference between traders who succeed for decades and traders who burn out in months often comes down to these daily practices. Remember this: success in trading is not one dramatic breakthrough. It is the accumulation of small, consistent habits that compound over time. Strategies may change, markets may evolve, but your mindset rituals remain your anchor. They keep you grounded, focused, and strong. In the next chapter, we will take everything you have learned and bring it together into a new identity, the identity of the calm trader. Because mindset rituals are not just actions, they are the foundation of who you become. Chapter 10, Becoming the Calm Trader, your new identity. To this point, we have explored the forces that sabotage traders: fear, greed, impatience, overconfidence, revenge trading. We've studied the psychology of the brain, the importance of discipline, and the rituals that build resilience. But all of this leads to one final essential step: identity. Because in the end, lasting change in trading does not come from willpower alone. It comes from who you believe you are. If you see yourself as an impulsive trader, you will act impulsively. If you see yourself as a gambler, you will chase trades like a gambler. But if you see yourself as a calm, disciplined trader, you will naturally begin to act with calmness and discipline. Identity is powerful because it shapes behavior. We don't act in line with what we want. We act in line with who we believe we are. That is why so many traders struggle to change. They try to force discipline with rules, but deep down they still believe they are reckless. They try to manage fear and greed, but deep down they still believe they are emotional. The change doesn't last because they are trying to fight their identity. To truly transform, you must step into a new identity. You must become the calm trader. So what does it mean to be the calm trader? The calm trader is patient. They wait for their setups. They know the market will provide endless opportunities, so they feel no rush. They trade less, but they trade better. The calm trader is disciplined. They follow their plan every time. They set their stop loss and never move it further away. They take profits according to their rules, not their emotions. They measure success by discipline, not by dollars. The calm trader is detached. They know that one trade does not define them. A win does not make them invincible. A loss does not make them a failure. They see each trade as just one step in the process, nothing more. The calm trader is resilient. When they lose, they reflect, reset, and return. When they win, they remain steady, not overconfident. Nothing shakes their balance for long. The calm trader is consistent. They treat trading like a business, not a lottery ticket. They show up with preparation, execute with clarity, and stick to their process day after day. The calm trader is confident. Not because they always win, but because they trust themselves. They trust their system. They know they can handle losses. They know they can handle wins. Their confidence comes from discipline, not from luck. This identity is not about perfection. You will still feel fear. You will still feel greed. You will still be tempted to break your rules. But as the calm trader, you recognize those emotions without obeying them. You acknowledge them, and then you choose discipline instead. So how do you embody this identity? The first step is affirmation. Begin to speak as the calm trader. Tell yourself, I'm disciplined, I'm patient, I'm calm under pressure, I follow my plan, I trust my process. These words may feel strange at first, but repetition matters. The more you affirm, the more your brain begins to accept this identity. The second step is action. Identity grows through behavior. Each time you act like the calm trader, you strengthen that identity. Each time you follow your plan, you prove to yourself that you are disciplined. Each time you walk away instead of revenge trading, you prove that you are resilient. Small actions build powerful identities. The third step is environment. Surround yourself with reminders of who you want to become. Keep your trading journal visible. Place affirmations near your desk. Follow mentors who embody calm discipline. The environment you create will reinforce the identity you choose. The fourth step is reflection. Each day ask yourself, did I trade as the calm trader today? Not, did I win? Did I lose? How much money did I make? The real question is, did I embody the identity I want to become? Over time, this question reshapes your focus from outcomes to character, and the fifth step is patience. Identity does not change overnight. Becoming the calm trader is a process. You will slip, you will forget. But every time you return to discipline, you strengthen the identity. Slowly, surely, you stop pretending to be calm, you become calm. This transformation is the ultimate edge. Strategies can be copied, indicators can be bought, systems can be shared, but identity cannot be copied. The calm trader is rare, and in a world of impulsive, emotional, reckless trading, calmness is the greatest advantage you can have. Conclusion, you're the edge. Now, as we come to the end of this journey, reflect on what you've learned. You've seen how emotions destroy good traders. You've discovered how the brain's instincts can betray you. You've explored fear, greed, discipline, calmness, revenge trading, recovery, and rituals for success. But above all, you've learned that trading is not a battle against the market. It is a battle against yourself. The market is not your enemy. It is neutral. It does not care whether you win or lose. The only thing that matters is how you respond to it. Most traders spend their time searching for external edges, new strategies, new systems, new indicators. But the truth is, your greatest edge has been inside you all along. It is your ability to master your emotions. It is your ability to stay calm when everyone else panics. It is your ability to trade with discipline, patience, and clarity. That is why you are the edge. When you embody the identity of the calm trader, you no longer chase the market. You no longer sabotage yourself. You trade with confidence, not arrogance. You trade with discipline, not impulse. You trade with calmness, not chaos. The calm trader is not someone you pretend to be. It is someone you become. And once you become that trader, no market condition, no strategy, no loss can take that away from you. This is your path now, a path of patience, discipline, resilience, and growth. A path that does not guarantee profits every day, but that guarantees progress every day. Remember, the market will always test you. It will tempt you, challenge you, and push you. But you are ready. You know the traps. You know the emotions. You know yourself. So take a breath. Trust your process. Step into the market not as the trader you were, but as the calm trader you have chosen to become. Because from this moment on, you are the edge.